go through some basics of accounting. And like I said, for a lot of you, this is going to be just kind of a review, and some of you could probably teach this section, and you're welcome to come up and teach it if you like. But just the basics of accounting, because we need to know this information in order to learn the journal entries that we have to make. Accounting, why do we do it, first off? There are lots of users of financial information. There are creditors, there are investors, there are internal users, management, certain governmental agencies. There's all sorts of different users of the financial information. It has to be put into a understandable and uniform format. So this is why we do accounting. Accounting consists of the journal entry itself. Accounting consists of journal entries at its core. It's a series of journal entries. So, and each journal entry has two sides to it. It has a debit and it has a credit. So debits, now we abbreviate them as DR. I don't know why it's an R. There's no R in debit, but it's DR. Has anybody ever asked that question before? Why is it DR? And credits. And it doesn't mean debits and credits like what are on your bank statement. Debits and credits in a bank statement essentially mean deposits and withdrawals, right? If you're credited on your bank statement, that means you got money coming in. If there's a debit, that means you got money coming out. Doesn't mean that in accounting. It has a different meaning. Debit essentially just means left, and credit means right. That's all it means. When we have a journal entry, we have two sides. Both sides have to equal each other. The left side of that journal entry has to equal the right side of that journal entry. So, and we have accounts. So we've got, let's say we've got expense account of 100. And we have, so let's say we paid cash for something. We paid $100 cash, we purchased, so it's an expense. Let's say we paid for our utilities, okay? So we have utilities expense. We're gonna debit that for 100. We can't just leave it like that. There are two sides to every transaction. We paid for that utilities with cash. Now we have cash going out. Whoops, not X. Now we have a journal entry because we have two sides to the journal entry and both sides equal each other. They always have to equal each other. By the way, this seems simple, especially for those of you I know that are working in accounting. This seems like a simple concept. I taught intermediate accounting. I had students that still didn't get this when they came into intermediate accounting. So this is very crucial to know that both sides have to equal each other, right? There are different types of accounts. And by the way, I don't teach financial accounting, so I'm digging back into the recesses of my memory when I go through this stuff. There are different types of accounts. And actually, you guys tell me what the types of accounts are. Assets. First off, let's start with the accounting equation. There's an equation, right? Assets
Equals liability plus equity.
Liabilities plus equity. And these, they always have to equal. This again always has to be in balance. So whatever your total assets are has to equal what your liabilities plus your equity are. Assets are things that you own that will help generate income at some point in the future. If you think of it from a business perspective. Liabilities are things that you owe, amounts that you owe to others. Equity is essentially just the difference between those two, right? It's whatever you have left over after you subtract your liabilities from your assets. Hopefully you've got something left over, right? If not, you've got some problems. So we have these normal balances for the accounts. Oh, I should say. So assets, certain account, let's think about asset accounts. We're talking about for the most part in here, I don't think there are any others. We're talking about cash. Cash is an asset, right? Liabilities, anything with a payable. So like salaries payable, wages payable, amounts that at some point in the future are going to be payable to somebody else. Payroll taxes payable, garnishments payable, that sort of thing. Equity, under equity we have, and this seems kind of weird because this is a balance sheet and we don't have expenses on a balance sheet, but we do have expenses on a balance sheet, and it comes in the form of equity. Okay, so our equity is essentially included in our equity is income minus expenses from a very simplified perspective. So under our equity, we've got our expenses. Those would be things like wages expense, salaries expense. Those ultimately come into the equation in the form of retained earnings. So these are the major accounts that we're going to be working with. We're going to be talking about cash, we're going to be talking about payables, and we're going to be talking about expenses. Now, we have some normal balances for these accounts. Like I said, we've got debits and credits are our two options here. Debit just meaning left, credit meaning right. Normal balances for debits are assets, expenses, and what we don't talk about in here, but we'll mention, dividends. These accounts normally have a debit balance. If you're going to increase these amounts, if we have an increase in expenses, that means we're going to debit expenses. We have an increase in expenses when we incur an expense, right? When we pay our employees, we incur an expense. And so that means we're going to debit that expense account. Now, I don't know if other instructors have pointed this out, AED, Anderson, Erickson, Dairy. This is a way to remember these normal balances. It works for Iowans, it doesn't work for anybody else. So Anderson, Erickson, Dairy, if you can remember that, these are the only accounts that have a normal debit balance. Knowing this will help you to figure out any journal entry. It really will. When I was practicing, and like I said, I'm not a financial accountant, but I still had to work with QuickBooks, and I still had to help with compilations and reviews, and I still had to make journal entries. This helped me to remember what was the correct balance. Everything else, every other type of account, so our liabilities, which essentially income, remember I said income minus expenses equals our equity. Income, I'll put equity down here. Any other equity. Those all have a credit balance. Every other type of account. So if you can remember Anderson and Erickson Dairy, you know that these accounts have a debit balance, which again simply means is written on the left-hand side of the ledger. These are the main types of accounts that we're going to use here. So we've got, we're going to talk about assets, which essentially are cash. We've got expenses, which are usually our payroll, like wages, and taxes. We're not really going to do anything with dividends here. we are gonna talk about liabilities. These are gonna be payables. So things like OASDI payable, Medicare payable, wages payable, something we've got to pay at some point in the future. We're really not going to talk about equity or income. So these are the main accounts that we're going to look at when we're making our journal entries. Cash, wages expense, taxes expense, payables consisting of like OASDI, Medicare, wages payable, garnishments, that sort of thing. Okay. So these are the ones that I really want you to kind of focus on in this section. All right. So when we're entering payroll data, we have a payroll, and we're entering data. We're going to enter it in this order. First thing we're going to do is enter it into the payroll register. So that listing of all the employee information for this particular payroll. Then we're going to enter it into the employee earnings record. So we're going to pull all of the information for each individual employee, pluck it out of that payroll register, and put it on the employee's earnings record, so that we can get an idea cumulatively, again, where the employee stands. Then we're going to use those to make our journal entries. We're going to use the information from those to make our journal entries. And we're going to enter them into the general journal. What is the general journal? So this is just a listing of all the journal entries for a particular period in time, and they're recorded in date order. So starting with the first day of the month down to the 31st day of the month, we've got a general journal for this particular month, right? So it's easy to mix that up with the general ledger, which is different. It also consists of journal entries, but it's by accounts, okay? So, but this is the order we're gonna do this. So you've got the payroll register, enter it into there, pull out the information we need for each individual payroll to enter it in the employee earnings record. And then from that, we're going to pull out the information that we need to make our journal entries.
I have a question.
Yes.
So for your general journal entry, will those all be entered individually for every employee, or will they be just kind of compiled?
No. You wouldn't do it for each individual employee. You're gonna do it, but you will do it for like departments.
Yes.
Yeah, so if you've got, the payroll department, you'll make a journal entry. And you'll want to do that so that you've got that internal information on expenses, on what you're spending on each department, right? Again, you don't have to, but the more specific you can get with the information, the more usable that information is gonna be. The more you're gonna be able to make decisions with that information, the more specific it is. So that's why we would prefer to do it that way. We've got 4 main journal entries that we're gonna make. I'll just talk about these. We'll go through them next Tuesday. But we're gonna talk about 4 different journal entries. 2 of those entries are made on the day that payroll occurs, on the day that the employees are paid, okay? One of them is to record the gross payroll and withholdings. So this is from the employee's standpoint. So all of that payroll register information for this particular payroll, what was paid to the employee's side of that. How much were they paid? Their gross pay, and then all the amounts that were withheld from their paycheck. Okay, we're not gonna do anything, not in this first journal entry, we don't include any information about the employer's responsibility. It's only the employee's information. So, we record the gross payroll and any amounts that were withheld, as well as net paychecks. Second journal entry also is done on payday. This one records the employer's portion of the responsibility, their taxes. Okay, so payroll taxes, also any workers' compensation insurance or other types of like FUTA and SUTA, that type of stuff, that is the responsibility of the employer. The employer's portion of Social Security, employer's portion of Medicare tax. So this second journal entry is not going to have anything to do with federal income taxes or state income taxes, because the employer doesn't pay any of that. The employee pays that. That's going to be part of the first journal entry. So those are our first two entries. Both of these are done on payday. Next journal entry, third one, is going to record the deposit and the and the payment of the payroll taxes. So this happens when the payments are actually made. So this is going to be on a different day from payday. Maybe it's going to be the next day if we have a next day payment requirement. Maybe it's going to be on Wednesday or Friday, depending upon when our payday is, if we have a semi-weekly deposit schedule, right? Or maybe it's going to be next month. But whenever that payment is actually made, that's what we're going to make the third payment. The fourth one, and you'll see with these first three journal entries, some sort of financial transaction has occurred, right? These first two, we paid employees. There's a financial transaction there. The employees have been paid for both of these. This one, taxes have been paid. Some sort of payment has been made. This last one, though, is triggered not by an actual event, transaction, financial transaction. It's triggered by the end of an accounting period. These are the adjustments. The adjustments that have to be made at the end of that period. So either monthly, quarterly, annually, maybe all three. Maybe we have to make adjusting entries all three of those times. Most likely, probably monthly and annually. So these are the end of period adjustments. That's the fourth journal entry that we're gonna look at and study. Okay? Questions? You're just anticipating learning the journal entries, right? Okay, so we'll go ahead and wrap it up for today.